Thank you for listening to me this evening. That biography is now more than 7 years old. I actually have 36 years experience in the gold mining industry. I started as a mining engineer. Do you know how dangerous it is to give a mining engineer free alcohol and then expect him to start speaking at 9:30 at night? So I hope you appreciate my discipline in not doing so. Now look, we're the World Gold Council. I represent the World Gold Council. This is owned by mining companies around the world. I've been asked at our table tonight, so what actually does the World Gold Council do? What we do is we're effectively the marketing organization for the gold mining sector. We have 33 member companies, including Agnico Eagle and Cisco Royalties. We were set up more than 30 years ago to develop the gold market. We've done lots of things over the years. I'm probably most proud of taking the Chinese gold market from 200 tons a year to over 1,000 tons a year by working with the Chinese government to develop the Shanghai Gold Exchange, the Shanghai Futures Exchange, and the ability for Chinese people to invest in physical gold, which they couldn't do prior to about 2004. We also invented gold-backed exchange-traded funds. So the GLD, which trades in the States, it's about $60 billion assets under management. And then its little brother, GLDM, which is a smaller version of that with about $6 billion under management. Those are our products. Collectively now, there's more than 100 physically backed gold exchange-traded funds around the world. We invented that concept. It revolutionized the gold market. I'm the Chief Market Strategist. I'm the principal spokesperson for the organization. You will have the opportunity to ask me anything about gold. I might not tell you the answer, but I probably know it. But we'll see. What I can't do, I can't give you forecasts. Because of our ownership structure, we really do not want to be considered to be manipulating the gold market like OPEC manages the oil market. So I can't give you numerical forecasts. But I can certainly talk about things that may happen in coming years. Here are 32 of the companies that are members. I'm embarrassed to say this slide is slightly out of date, and the Cisco Mining Royalties is not on here. It was on the speech I gave earlier on, so I do apologize to Cisco Royalties. Okay, so I'm going to talk about two things. I'm going to talk about the state of the gold market. We've just come to the end of 2022. Which was a really important year for gold for reasons I'll explain. Of course, we've just finished the first quarter of 2023, but it takes us a little while to collect the data and talk about what's happened in the first quarter. Even I don't know what some of the important numbers are yet. That report will be released on the 5th of May, so you'll have to wait for it, but it's going to be interesting for reasons I'll explain. I think the first thing to start with is to think about the shape of the gold market. There are lots of different moving parts in gold on the demand side. Jewelry is still really important, 37%. It's not very big in the West. But in India, particularly, also in China, massive purchases of gold jewelry. And it's really important. You can imagine, you take any market, you take 37% of that demand away, you'd have a big problem. Investment is bigger. These are averages over the last 10 years as well, so it smooths out the peaks and troughs. But investment at 38%, and that consists of both exchange-traded funds, which get spoken about a lot, but also bar and coin investment, which is much bigger, and I'll touch upon that. Central banks have bought gold every year since the global financial crisis. They're a really important part of the market. You may remember in the 1990s and the 2000s, the Bank of England sold a load of gold. The Swiss National Bank sold a load of gold. That's stopped now. Central banks are buying gold. And that's probably the biggest story that we saw in 2022. Finally, every electronic device that's in your pocket and on your tables in front of you contains gold. If we didn't have gold in electronics, everything would be, well, 1970s style, big and bulky and wouldn't work very well and would break more often. Gold is an essential part of the 21st century, but we don't need very much of it. Only about 7% of annual demand for gold goes into technology, and that might grow a bit, but it's never going to be the main story. So you'll hear lots about metals that are vital for the transition of the global economy to a carbon-free future. And gold is included in that, but it's never going to be the main driver. It's vital, but relatively small. So 2022, the strongest year of gold demand in over a decade, in spite of the fact that we saw investors around the world selling gold via exchange-traded funds. This gets tremendous amounts of headlines. Bloomberg writes stories on this every day. The World Gold Council produces a report every month. We talk about ETFs a lot. Last year they sold 110 tons. Okay, fine. Don't like to see people selling gold, but it happens. Contrast that, bar and coin demand, little bars that you buy in the shops in Zurich, coins you buy all over the world, 1,200 tons. It's a much more important market, and we don't talk about it as an industry enough. Why? Because the data's hard to get. People rely on our quarterly data to get an estimate of what bar and coin demand is doing, but every day you can see how much ETFs change. So if you see a headline, ETF investors buy or sell gold, yeah, pay attention, but do understand it's not the biggest part of the market. But the biggest story last year was central bank purchases. They bought more than 1,100 tons of gold last year. That's the biggest amount ever. And I'll talk more about that because it's really important. Mine supply, recycling supply. Look, it's really important to our members. They produce a lot of gold. It doesn't change very much year on year. It increased a bit last year. It was up 2%. In terms of the changes in the gold market, it doesn't really matter. Okay, so let's talk about some of those numbers. Jewelry demand got hit really, really hard during COVID. Markets were closed. People couldn't buy gold. They couldn't get to the shops, particularly in China. 2021, nice rebound. 2022, down a little bit. Why? Well, we all know what happened in China with COVID last year. They locked down again really hard. This will bounce back well this year. All the indications we're getting from our analysts in China and from speaking to the trade, so we're going to see a big rebound in Chinese jewelry demand this year. So the jewelry market, 37% of demand, really important, probably doesn't drive the price higher, tends to react when the price comes lower, buys more, but a really important component of demand. That's doing fine. This is my point on ETFs. These are annual changes in ETF holdings of the 100 or so ETFs that we track on a daily basis around the world. You'll see sometimes ETFs are really important. Look at what happened in 2020, in the COVID year. We had 800 tons of net increases in gold held by exchange-traded funds. Look at what happened in 2013. 2013, we saw about 950 tons of selling when the gold price was busy correcting. But most of the time, the inflows and outflows are relatively modest. And this probably averages out about, I don't know, I haven't done the maths, I really should, 200, 250 tons a year. Contrast that with bar and coin demand. And these are quarterly numbers. Quarterly, 350 tons of gold bought by bar and coin investors. Gold is a really important physical market as well as a financial market as well. I think this chart's really interesting because what it shows you is Western world bar and coin demand. Do you remember the global financial crisis in 2008? The gold market does, because it completely changed what individuals, retail investors did towards bar and coin demand. Prior to that, sometimes they bought, sometimes they sold. But after the global financial crisis, we have seen steady, strong buying from the United States and from Europe. And by Europe, I mean Germany, Switzerland, a couple of other Northern European countries. This is a German phenomena, it's a Swiss phenomena, and it's been really strong. Okay, it was declining a bit, and I'll try the magic technology and see if I can. Yeah, there we go. It was declining a bit, 2017, 18, 19, but then the COVID came along. People sat at home, lots of money, nothing to spend it on, can't go out drinking, buy gold. And then, well, that's personally what I did anyway. And then as we came out of COVID, or began to come out of COVID, what happened? Inflation picked up. Investors bought more gold. And last year they bought more gold. And this year, so far, we think they're also buying more gold as well. Helped massively by the problems that we're seeing from the banking sector. But it's central banks which was the biggest story last year. Now, this is history over the last 72 years. I'm not going to go through it all. But there's a couple of things I'd point out. The period here, magic number, there we go. This period here, I think it was 23 years of consecutive selling by central banks through the 90s and the 2000s, including, as I said, Bank of England, average sale price, $275 an ounce. That's a win. Swiss National Bank, $440 an ounce. Wonderful. France, Australia, Canada. Basically, these were the developed market central banks that at the end of the gold standard ended up with loads of gold in their international reserves. Now, we advocate investors hold gold in their portfolio. We advocate central banks hold gold in their portfolio. Some of these central banks had 30, 50, 70% of their FX reserves in gold. Even I'd say that's too much. So you can't fault them for wanting to reduce their holdings of gold. You can certainly fault them for their timings. So then came the global financial crisis. The developed market central banks that were selling gold stopped. They stopped because suddenly they realized that having gold in your portfolio was a good thing. It went up when bad things were happening, when the value of all their other assets were going down. Also, these high-quality government bonds they were buying weren't so high quality anymore, and they certainly didn't yield the same interest rates as they did before. So they stopped selling. So what's happened since then is every year since the global financial crisis, emerging market central banks have been buying gold. And they've bought between 250 tons a year to maybe 650 tons a year in 2018. Fine, great. These are countries that at the end of the gold standard didn't have any FX reserves. But what have we seen in economics since then? We've seen these countries grow massively, and we've seen their FX reserves get enormous. So now they realize, well, we don't have any gold. Gold's done really well during crises. We should add gold to our holdings, and that's what they've done. But last year, they didn't buy 250 tons of gold. They didn't buy 650 tons of gold. They bought 1,100 tons of gold. In fact, they bought 800 tons of gold in the second half of the year. So why is that? Well, the first thing is, I'd say, is we're not surprised that central banks were buying gold last year. We have relationships at the World Gold Council with about 95% of central banks in the world. The only ones we really don't talk to are the ones that are under sanctions, which we've been prohibited from talking to. So obviously there's a couple more of those in last year. But each year we ask all the central bank contacts we have on an anonymous survey, what are their intentions regarding their foreign exchange reserves? Particularly, what are they going to do with gold? Are they going to hold on to it? Are they going to sell it? Are they going to buy more? And then technical questions like, well, where do you hold it? Do you hold it at home? Do you hold it in the Bank of England? Do you buy the large bars? Do you buy small bars? Do you buy ETFs? Some do, surprisingly. But every time we've asked central banks over the last 5 years what they're going to do about gold, each year they've said they're going to buy more. So we got to the survey we did in early 2022. We got to, I think, 25% of the respondents said they were going to buy more gold. So that's a big number. So we're not surprised that central banks bought gold. But why did they buy so much? Well, for that, you've got to turn to the war. When Russia invaded Ukraine, we saw sanctions imposed upon Russia. I think that was expected. I remember lots of conversations about SWIFT and Russian banks being kicked off the SWIFT settlement system, individual sanctions being placed against Russian politicians and business leaders. But I didn't expect to see the West sanction the Central Bank of Russia. And it wasn't just the US as well. It was the European Union, it was the UK, it was Japan, it was Singapore. Even Switzerland sanctioned the Central Bank of Russia. And you know you've gone wrong when you've pissed off the Swiss and got them to do financial sanctions. I mean, I was shocked. And I worked for UBS for a long time. So what did that mean? That meant roughly half of the Central Bank of Russia's foreign exchange reserves were now locked up. And this has caused people to have a real think about what foreign exchange reserves mean. I think politicians, not usually the brightest people in the world, think of foreign exchange reserves as a pile of cash in a vault that they can use to buy stuff with. But of course it's not, is it? What did Russia own? It had sold most of its dollars, but it owned European bonds, UK bonds, Japanese bonds, money market instruments, stuff in the clearing system of these countries. And these countries said, no, sorry, you can't use that anymore. That's gone away. Fine. But what Russia did have is more than 20% of its reserves in gold, held in Russia. Okay, can't sell it into the Western markets because that gold is sanctioned, but it can sell it anyway. It can sell it in other markets that aren't sanctioning it. Not that it has so far, but it could if it needed to. And I think this has led to big changes in the way that many central banks, who are not part of the Western sanctions group, to think about what should be in their foreign exchange reserves. Now, I'm not saying that the multi-trillion dollars of FX reserves are all going to go into gold. But what I am saying is when we asked at our central bank conference, closed-door conference every year we do, no journalists, no investment bankers, just the World Gold Council, central bankers, and some invited macro speakers. We asked at dinner very much like this, after a few glasses of wine, said, how many of you, central bankers, have changed the way that you think about foreign exchange reserves as a consequence of the sanctioning of the Central Bank of Russia? Half the room put their hand up. So it's unsurprising that we've seen central banks adding to gold holdings at an unprecedented rate ever last year. And there's some really important buyers of gold in there as well. Biggest holder of foreign exchange reserves in the world, People's Bank of China. More than $3 trillion. They've got gold, or had gold, didn't have very much as a proportion. In November, they've announced additions. December, January, February, March, they're buying gold. That's really important, because when you speak to central banks, and you say to them what they should be doing and what they should be thinking about, the first question they always ask is, well, what's China doing? Because China's the elephant in the room, and you don't want to be getting in the way of the elephant. So with China buying gold, hugely influential on other central banks. And the second one is Singapore. Now, Singapore is now a developed market. It's one of the very few emerging markets that's climbed up that cliff and has been awarded developed market status. Massive foreign exchange reserves, really successful economy. A bit like Switzerland, but it's hot and sweaty. They bought gold in 2021, and they bought gold this year as well. And that's really important. It's important they've got massive FX reserves and they can buy gold for a long period of time and still have a reasonable amount. But also, emerging markets around the world look at Singapore and say, that's what we want to be like. Hugely influential in the emerging market community as the poster child of what we need to follow. So those two central bank purchases alone are hugely important. Now, we'll be releasing new data for Q1 gold demand trends on the 5th of May. The most closely followed number within that will be, what have central banks done? Because if central banks keep buying large amounts of gold, it could fundamentally change the market. There's $15 trillion of foreign exchange reserves. If this rate of purchase continues, will revolutionize the gold market. We personally formally forecast that it will slow down. And there's some reasons for that. Global FX reserves are shrinking a little bit. But to be frank, the error range on our forecast is, well, probably as tall as the ceiling. We just really don't know. We have really good relationships with central banks, but they don't tell us what they're going to do, which kind of makes sense. So watch out for that number. That could change the gold market permanently. I said mine production. In the long term, it's grown a lot. Excuse me. But year on year, it doesn't grow very much, despite all the efforts of our members. We still aren't at all-time high gold production. That was back in 2018. Yes, it was 2018. And it's declined a bit from that. COVID played a role there. Also, safety stoppages in China played a role. It might hit a new all-time high this year. But I think if you speak to any mining executive around the world, they will say the industry is going to struggle to sustainably grow gold production going forward. Many forecasters are talking about a decline in gold production because of the difficulties of finding new mines. I don't see mine supply as a threat to the outlook for the gold price. Mine supply doesn't change very much year on year. It might be up 1% or down 1%. What does change a lot, though, is recycling. So if you think about new mine supply as about 3,600 tons a year, recycled old jewelry and a little bit of old technology can be 1,500, 1,600 tons. It can be, as it was last year, about 1,100 tons. So to me, that's really interesting, is if you look at where the gold price was last year, it was a record high in most currencies, even on an average basis, a record high in US dollars. Not a great performance, but it still was high. But look at where recycling came in. Normally, you see recycling surge when the gold price goes up, like it did during the global financial crisis, but it hasn't this time. So this is a potential overhang for the gold market that hasn't turned up. Gold price is going up. You guys aren't selling your jewelry and sending it off to the refineries to be recycled. That's hugely positive. Okay, so that's where we stood in 2022. What have we seen since then? What I call tactical, shorter-term thinking about gold. For this, I pay a lot of attention to positioning. I pay a lot of attention to what's happening in the US dollar. I pay a lot of attention to what's happening in the fixed income markets. One of the things that we've developed in the last 12 months or so is this, this model, which is available on our website, gold.org, all available for free. Sign up for it, get great research, and models. And this is one of the models. This shows you what drives gold on a monthly basis. And I'm not going to go through it in detail. Suffice to say, the biggest drivers of gold on a monthly basis, a daily basis, a yearly basis maybe, are foreign exchange in pink and in sort of purple, interest rates. Those are the biggest drivers of gold. Earlier in last year, we got a lot of positive contribution from what you might call risk and uncertainty associated with the Russian invasion of Iraq. By the time we'd got to this period here, by May, June, you see those green bars below the line? The risk premium associated with the war had fallen away. It's been about interest rates. It's been about foreign exchange movements. This is the chart of 2022, and it answers what I call the most common question I had in gold last year. Why didn't gold perform better in a high inflationary environment? The US dollar was at a 20-year high. We saw real interest rates, so TIPS interest rates in the States, 10-year TIPS, increased by 220 basis points. Gold ended up flat on the year. Previously, the biggest one-year move we've seen in TIPS was 160 basis points. It was in 2013. You remember that big selling we saw from ETFs? Gold fell 28% that year. Gold stood up really well last year to its two biggest macro adversaries, the dollar and interest rates. Gold hit new all-time highs in most currencies except for the US dollar. And that's because the dollar was just so strong against everything. This relationship between real interest rates and gold dates back to just around 2006, 2007. It's the number one chart that I used to look at. It's the number one chart the street looks at, Wall Street, in terms of determining where the gold price is. This is why Wall Street was so negative on gold last year, is if you look at this price here on real interest rates, you'd be thinking gold should be trading at $1,000 an ounce. This is broken. And it's broken because inflation's high. And it's taken Wall Street almost a year to work out that this no longer works. So what about positioning? What are the investors and speculators doing? This shows net long positions on the COMEX futures market. I've got this data back to 1985, I think. And it's a really useful indicator of how bulled up people are, short-term speculators are about gold. A couple of things to notice here. When the bars are below the line, that means they're short. If you ever see that, close your eyes and buy gold with both fists, because it doesn't happen very often, and it always leads to an increase in the gold price. Maybe not immediately, but a month or two. Some of the biggest rallies we've seen in gold have happened when people get negative on gold on the COMEX futures market, as they did in the third quarter of last year. So we've seen a decent rally in the gold price since the end of November, and we've seen investors and speculators getting involved. But if you look at the size of those positions, shown in the arrow here, compared to where we've been previously, there is room for them to add more. But what you haven't got is a short market. This is not a table thumping buy gold now because you've got a great short-term opportunity. This is, okay, there's room to grow, but we're not there yet. If you follow finance theory, seasonality shouldn't work. If there is a seasonal pattern of demand and supply, it should be arbitraged away by clever people who recognize it, but that doesn't actually seem to happen very much. It's interesting, January, good time to buy gold, or maybe late December, always a good time to buy gold. Third quarter, typically a good time to buy gold. We've been through March, which normally is a bad period. Now we're kind of neutral territory. For those of you that are thinking of timing your investments, August. Come back from your summer holidays, have a look at your gold, have a look at your gold shares. Typically are not a bad time to buy. So what's the outlook? There's lots going on this year. We put our outlook out in January, and of course everything's changed again already. I think to me, the biggest issue is the playoff between what's going to happen with the US economy, the banking system, and the Federal Reserve. The Fed sounds hawkish. The markets don't believe it. Look at equities, they're rallying. Look at what the Fed Fund Futures curve is suggesting. The Fed Fund Futures curve is suggesting that the Fed will cut rates this year. And the banking sector is telling you is if 10-year bond yields get back up to 4%, you're going to see more bank runs, more bankruptcies, more bank problems, primarily in the United States. That's what's going to define what happens in gold this year. On the one hand, the Fed stays hawkish, gold probably corrects a bit. We've seen some money come into it via the COMEX futures market. But if the Fed stays hawkish, hikes rates, the curve goes up, banks start to go into bankruptcy, gold gets bought for safe haven reasons. If the Fed's dovish and does pivot and does start cutting rates, dollar probably falls. Dollar's come a long way. It's corrected a bit, but it's still pretty expensive. And that big increase in the dollar last year could unwind. That'll be positive for gold as well. So we don't give forecasts. I'm glad to see that two of our members did. Amar, I'm most impressed. All I can say is I personally think we will see volatility through the first half of this year, more volatility. But I think by the second half of the year, it will be apparent which way the Fed is going to go. Either way, I think it will be positive for gold. Either they risk more banking turmoil, or they start cutting rates. 2,500, I hope, it is a long way to go. I wouldn't rule it out. I got asked at a conference in February or January, do you think gold will trade 2,000 this year? I said, I'm 99% certain gold will trade 2,000 this year because we were trading at 1,900 at the time. Gold can do $100 in 2 days. We've seen that. Can it trade 2,500? It could. The rest of your portfolio might look pretty shit if it does, I think it's fair to say. And look, I spend most of my time talking to institutional investors and why you should have gold in your portfolio all the time. We recommend an allocation of 5, 8, maybe 12%, depends what's in the rest of your portfolio. That's the strategic reason why everybody in this room should own gold, whether it's physical gold, whether it's through gold shares, gold indices, whatever. There are tactical opportunities as well. Gold does well during crises. 2023 looks like it could have 1 or 2 more to come. I'm going to stop there. This is your opportunity. How long have I got, Patrick? How long have we got to ask me questions? Right, ask me anything about gold. And I mean that genuinely. Ask me anything about gold. I've been doing this for 36 years. I probably know the answer. I may even tell you it.
Yeah, John, thank you very much for a great presentation. I think we are all gold and silver bulls here in the room, that's for sure.
I found it silver. I forgot. I've got a chart.
Exactly.
I've got a chart on silver. Okay, here's an interesting one for you.
Oh, I shouldn't have said that.
You shouldn't have said that. You know what silver tells me? If I look at the gold-silver ratio, because with the World Gold Council, I don't pay any attention to silver anymore. I used to. But when I do pay attention, the little bit of time I spend attention, I look at it gold relative to silver, because it usually tells me a lot about what's going on in the market. And the gold-silver ratio at the moment, at about 80, tells me that investors haven't got into gold yet. Mm-hmm. I think one of the reasons for the relatively strong performance of gold last year was central banks. They bought a shed load, okay? They bought a huge amount of gold in the second half of the year. We haven't seen those flows come through into ETFs. In fact, ETFs sold the last 8 months of last year, and in January and February this year. They only turned positive in March, and even then not very much. ETF investors are not involved. This chart tells me silver investors aren't involved. This tells me that investors are not in gold yet. So if the kind of crises that we're talking about are really going to come through, there's room for people to get involved. Now, I can't trade gold or gold shares. I mean, theoretically I can, but I think I'm locked out of it for 8 months of the year because of the restrictions that we do, so it's just too hard. I don't. I can trade silver, though. And for those of you that have known me for a long time, I have been famous at UBS for saying silver is a piece of... Okay, I can't use that word again. But for reasons you point out in terms of supply and demand, I think silver's a lot more interesting now than it has been for a while. And it's cheap relative to gold.
Really cheap, yeah.
One of the things I would say to you, though, last year, India imported enormous quantities of silver. So far, the data this year shows they're slowing down. They caught up a lot last year after very low imports in 2020 and 21. I'm really interested to see what happens with the Indian import numbers that will be coming out. Metals Focus, who we use as our data partners for gold, come out with a new silver survey in a week's time. Mm-hmm. Have a look at what they're expecting. Okay. I think silver's cheap. I am concerned a little bit about what happens to India because it was such a big swing factor in the markets. Mm-hmm. And as you pointed out, watch out for the stock movements out of COMEX, the stock movements out of London. Mm-hmm. If silver goes back to about a 50 ratio from an 80 ratio, and gold goes up, you can see silver double from here. Mm-hmm. That's not a forecast, but I'm paying more attention to silver than I have done for years. Last time I remember the sort of positivity about this was back in 2011, when silver touched $48.50 briefly. I was also asked actually to talk about gold mining equities, and for this you need to hear a little bit about my job when I worked at Paulson. I joined Paulson in the beginning of 2010. I'm not supposed to talk about this, but I've had a few glasses of wine, so who cares? We put billions of dollars into gold and billions of dollars into gold equities back at the beginning of late 2009 before I joined, and then into 2010. This is how gold equities performed with the gold price until I got fired. And I got fired at the end of 2016, which I thought was really unfair because we were up 70% that year. But as John Paulson said, he said, yeah, but your gold fund's down more than 75% since inception because of this massive underperformance of gold equities versus gold. That was horrible. But look what's happened since then. I think the industry is healed. I think a lot of bad decisions were made by the gold mining industry in the last bull market. They were chastened by the performance of their shares. They reduced their debt on their balance sheet. They've refused to commit to really expensive, potentially negative returning projects since then. And they've kept more or less in line with gold since then. There's been periods of outperformance. There's been periods of underperformance. But at least you can say, holding its own. Now, from a personal perspective, I think gold, the metal, should be a strategic component of your portfolio. We've got all sorts of slides later that talk about returns, diversification, and how having gold in your portfolio really benefits you as an investor. I think gold equities are a harder strategic conversation, but they're looking a lot better than they did. And if you are strongly convinced that gold is going to perform well in a 1 month, 3 month, 12-month view, the leverage that you'll get from gold mining companies will really help you. We've seen some great periods of outperformance, even within this period. So gold equities hurt me a lot. It looks like they won't hurt people as much as they have done in the past. There we go. Bit of a personal story there. Thank you.
Thank you very much.